Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And it's Monday, and we're all together, Scarlett.
I know. First time in this month, at least.
It feels like it. Yeah, the band is back together. Let's get to the biggest stories right now. In the $22 trillion global ETF industry, stocks marching higher, even in the face of failed talks between Iran and the U.S. President Trump saying that the ceasefire is, quote, on life support.
We're also keeping a close eye on Bitcoin. It is back above $80,000, that key level, and higher in the session today. We speak to Ally Wallace, global head of ETFs at Morgan Stanley Investment Management, about that firm's push into digital assets.
And we're also going to be speaking with the CEO of Corgi. That is the company drawing lots of interest from the industry as they launch a series of new funds, dozens of new funds from this upstart issuer. All that and more. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. The flows are interesting. They're pretty bullish. No surprise, right? The market's getting pretty frothy. People are actually worried about that. Is it too good to be true? What's going to happen next? Look at the top here, SPY. That means the trading crowd is really buying in here. Now, there's a lot of noise in the SPY flows, but still, 4.5 billion to SPY tells you traders are into the market right now. This is weird. DRAM, okay? This thing is only a month old. It has no business being anywhere near this leaderboard for weekly flows, but it's second. More on DRAM in a minute, why that's such a big deal. VU, obviously, always on the leaderboard, 2.7 billion. So you got traders and retail buying in. This is international. This is more Qs. This is treasuries, which isn't bullish. That might be a little bearish. And then VTI, but largely, I'd say net bullish by a mile. Let's look at the outflows here. You will see the Qs at the top. That could have been money coming out of there into QQQM. They kind of balance out. Now, semi's seeing outflows. I think there's a lot of traders who like to bet when there's an off day. When it goes up, they take profits. They tend to buy into the dips, and right now they've gone up so much, people are taking profits probably here. IWM, interesting. Small caps outperforming large by a good amount, but nobody cares, it seems like. Flows out of small caps, and then a little bit out of LQD and the Qs, or TQQ anyway. And let's look at DRAM. I want to look at this. This is probably the craziest chart that we've made all year in BI. Jack Wang on my team made it. Basically, if you look at DRAM, it is a memory ETF, tracks memory stocks. There's three big ones. It gives you all of them in one shot. And it's basically got to 6.5 billion in 36 days on the market. Now, that's the fastest any ETF has ever hit that point. The second fastest is IBIT, which we covered for like years on this show because it was such a juggernaut at 43 days. And then you've got Fidelity's ETF and then a bunch of rest down there. So this is pretty insane. I did not think anything, Katie, would pass IBIT. Now, will it get to 20, 30, 40 billion as fast as IBIT? Probably not. But for now, you just have to be pretty amazed by this, I would call it a phenomenon.
I am amazed. It's also amazing when you think of the expense ratio on DRAM at 65 basis points. Round Hill raking in the cash here. Eric, thank you. Let's keep this conversation going with Mayuranki D. She is Vice President of ETF Strategy over at Raymond James. Great to have you with us, May. And I won't ask you specifically about DRAM, though I would love to hear your thoughts. But you think about the chip rally that we're seeing in general, and you think about, the institutional audience that you work with over at Raymond James. I mean, are you able to say institutional isn't participating in this, or should we really chalk this up to retail?
So I think the interesting thing here is that when it comes to semiconductors, there's sectors, subsectors, and then there's the thematic vertical that we kind of look at. So when it comes to sectors and subsectors, they're much more inclined to invest in those areas, especially them being a lot of legacy instruments. So if you're talking SMH, SOX, definitely they're willing to put their money there. But then when it goes into funds like DRAM, they're definitely paying attention because they care about Samsung, they care about SK Hynix, they care about the Microns of the world, but maybe they're not willing to pour all of their money into these instruments technically. But if there are these huge funds that are coming out that are accumulating flows so rapidly, of course, they want to know how that impacts their single stocks, which is a huge concern for these ETFs. And then we've also seen TIMA, Crane shares, both applied for prospectuses right after the launch of DRAM. So it's definitely an area they're paying attention to, but I would say they're inclined to put their money more into, I guess, generalized vehicles, if anything.
So this level of retail engagement, especially when you look at DRAM, is that a bearish signal?
I think that it's so propelled by the retail audience that you think of it as a momentum trade in almost a sense. So yeah, right now it's accumulating heavily. What happens when everyone starts saying that these underlying names are too overvalued, it's overbought, and now people are going to be more hesitant I wouldn't say you're going to see a necessary outflow, but I can kind of see it do the same thing that QTUM did on a larger scale, where they accumulated super quickly at first and then just held. They're not rapidly accumulating anymore.
So this idea of watching something just go to the moon, and you're an institutional, serious investor, how hard is it to not jump in? It does feel a little silly sometimes, but then it goes up even more after that. I would almost bring it to the whole market. People say that about VU and Qs, like, can it go up anymore? And I've been sitting here for like 10 years now, and it always goes up more. So when does an institution take profits or hedge in a market like this, or do they just try to ride it as long as it'll go?
What's interesting is that it's very selective in the way that they do position. There are thematic areas like defense, where we've seen a lot of institutional interest. I would say it took a little bit longer for that crowd to join the Exodus, or join the inflow, as opposed to maybe the retail crowd who hopped on it immediately. But I would say it's very selective. I wouldn't say never to something like memory ETFs. I think they just are more selective because a lot of them are active managers, right? And so if they're putting their money into these hype trends, as a lot of people would look at them, they get backlash from the clientele that they're working for. So they're very selective, and some areas definitely get more attention than others. I'd say right now in thematics, something we see is the AI second derivative.
Right.
It's a huge thing, so they're more willing to put money into electrification or things like utilities, nuclear energy. But I think the memory is something they're still watching and not willing to go past the single stock names that they know they have high conviction in, even though it is such a niche, small set of names that you're looking at.
Absolutely. And in the case of DRAM, I mean, we're talking about an ETF that has only been live for just over a month here, so it doesn't exactly have a huge track record. I do want to talk a little bit about how institutions have been approaching ETFs as trading tools. It's a topic we've been talking about for years when it comes to ETFs in general. But, as ETFs get bigger, how are you seeing that in terms of the tail wagging the dog? When you think about the impact of rebalancing and, some of these index-driven flows, how that's actually impacting the underlying market and the underlying stocks?
Yeah, so there's a couple of verticals that branch out here. One is that I was lucky enough to be part of the ETF industry back in 2020 when thematics were the main trend and you saw this exponential growth in the market. But back then I was catering to a very retail clientele. Now in my current seat working with institutional investors, it's interesting because you see that they're using them as core implementation vehicles, but within the facets of hedging, tactical allocation, liquidity management, and even just maintaining benchmark exposure. I think a really great example of something that's existed for a while but is seeing even yearly uptick is maintaining alignment to a benchmark that an institutional investor might be tracking and using ETFs to manage the risk there. So biotech is something I always like to talk about. Let's say you're looking at the XBI, right? A small cap benchmark manager might say that I am very concerned about being underweight or overweight within biotech. I don't feel comfortable being a single stock picker in this area because I, frankly, am not an expertise.
Right.
They would look at something like XBI. About 9% of the Russell 2000 is in biotech, roughly. And XBI has about 2/3 overlap with the names within, let's say, IWM when it comes to biotech. If you're investing some of your money into XBI, that's a very easy and quick way to gain that tactical allocation without being exposed to names that you might not know whether they're going up or down and extremely volatile day to day.
So let's talk about your position there at Raymond James. Raymond James used to be, these networks of advisors are typically the most conservative when it comes to new ETFs. They want to wait for stuff to be around for a while. Athanasios on my team made a great chart. 23% of all the flows are going to ETFs that are less than 3 years old now. Now, granted, half the industry is less than 3 years old. That's how much new products there are. But are you more open to using new stuff? I imagine you're busy with this flood of products. Are investors like, oh, as long as it's an ETF, I'll look at it, or do they need to wait a couple of years?
It's interesting. There's this silent rule within the institutional audience where they all the time are not willing to look at most ETFs that have less than maybe 500 million in AUM. No one really talks about it, but it's kind of given despite how liquidity has increased within the ETF market. Now you can pretty much trade anything in bulk at a certain level. they're not really using the very new ETFs that come into market. What I'll say is that that doesn't mean they're not tracking them. So especially with the advent of active ETFs, a lot of these managers see them as competition in almost a sense. And so they'll be looking at what's going on in the market, use it as a benchmark, looking at market sector rotation. A lot of the ones that BlackRock, for example, would launch, like throw thematic rotation ETF, how does that compare to where they're at within their own portfolios? But like I mentioned, defense is probably a good area to look at, because when names like Shields launched, when active defense ETF IDEF launched, they were very akin to what's going on here. Maybe I can use this for a short-term allocation. They're not using it as a long-term core portfolio.
All right, May, gotta leave it there. So cool to get your perspective on what institutional investors are doing when it comes to the ETF landscape. That is Mayuranki D of Raymond James. Now, coming up, we're going to speak to Cinthia Murphy of TMX Vettafi on small caps outperforming large caps and why no one cares. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with State Street. You know, we talk about industry share a lot around here, and you take a look at State Street's share of ETF assets, and it's really slipped over the past couple decades as the industry has grown. You can see it's below 15% right now, and that compares to, you know, above 30% back in the aughts, if you will. Last week at Milken, I caught up with the CEO of State Street, and we talked specifically about this. Let's take a listen.
When we started out, it was they were institutional buyers, and today we still are the largest provider to institutions. What happened over the last decade was the entrance of the retail investor into it. And Vanguard and BlackRock went into that sooner than us and really did get ahead of us. But for us, our core market segment is the institutional investor. At times like April of last year, when there's all sorts of turmoil in the market, our ETFs will by far be the largest vehicle that's traded in the marketplace. So that's the core franchise that we want to protect. And in the meantime, we've aggressively grown what we call the low-cost segment.
So State Street focused on that institutional user. We were just talking about that space, of course, with Raymond James. And let's get back to that chart that Eric mentioned a moment ago. And a rising share of the flows are going into ETFs that are 3 years old or less. We're talking about 23% of the flows this year going into those young funds. You can see that's a record. But as Eric mentioned, I mean, a lot of the industry now is pretty young, certainly a sign of the times. And let's also talk about small caps versus large caps. I thought this was a really interesting chart here because much has been made, of course, of the big rebound that we've seen in the mega caps. But if you take a look at IJR here, that is a small cap ETF versus IVV, you can see that actually small caps are beating large caps year to date. That was true on the way down, and it's true on the way up. But I don't know if investors necessarily are noticing or if they care about that, Scarlett, just looking at the flows.
I know. I think about how on every Monday when Eric does go with the flow and he shows us how IWM is bleeding money, their net outflows. And this is even as small caps are outperforming big caps. What does that all mean? Why is that?
I don't know.
Let's talk about this with Cinthia Murphy. She's investment strategist at TMX Vettafi, and she joins us now. Cinthia, why is it that no one seems to care that small caps are outperforming big caps? I get that the market overall is at a record high, but small caps are doing what they're supposed to be doing and doing it better than anyone anticipated.
Yeah, it's funny because small caps seem to be plagued by recency bias, perhaps. I mean, last year, if you remember, we were all talking about 2025 would be the year of small caps, and then that led nowhere. So then here we are in 2026 and saying maybe this time around, and the numbers support it, but I think there's just a lot of skepticism. If you think about small caps, I mean, what's like working against them perhaps is that, they tend to be really high sensitive to interest rates, and we are no longer in an environment where we're anticipating a lot of rate cuts. So maybe there's a hesitation there to really jump in now. Maybe it's a little bit like it was for international stocks, where we need more than 1 year of outperformance before we start to see big flows. Maybe folks are waiting for more of a stronger confirmation that this rally is here to stay. But it's an interesting space because they're performing so well. Small caps a lot of them are really exposed to a lot of the popular themes like electrification, reshoring. There's a lot of small cap names in that part of the world, but nobody seems to care.
Yeah, Cinthia, I'm gonna blow your mind with this data here that David Cohn on my team found. Basically, 100% of small cap growth active managers are outperforming large cap growth managers, like every one. This was about 10% only a couple of years ago, like over 5-year and 3-year. It's only a year, but I'm surprised this hasn't moved the needle. The flows into those outperforming funds, negative 25 billion. I mean, that is so brutal. Now, Avantis is doing pretty well. This is the one firm that seems to have cracked small caps. What do you make of that?
Well, I was just going to say, like, if you look at funds like AVUV, AVSC, I mean, Avantis is just killing it and delivering performance and really standing out as, if you're going to go into this space and you're going to look for an active manager, they have the chops. Last year, they also beat the trend in small caps. So I think it's, if you put it all together and you think about all this demand we're seeing into the active managed space, which I think is one of the things that explains why we're seeing so much demand for new ETFs under 3 years old, it's because a lot of them are active, and we're finding both in the retail but also in the advisor space that they're willing to buy new to market ETFs to try and chase that active management that they're looking for. And so I think in the small cap space, a firm like Avantis, if you're delivering the numbers, it's only a matter of time as an active manager that people will pay attention. So I think it's a really interesting case.
I do also want to talk a little bit specifically about fixed income. We focus a lot on equities, certainly, especially with the rebound that we've seen. But you take a look at fixed income flows, they're certainly healthy year to date. You take a look at CLOs in particular. We know that has been a hot spot over the past couple years. Certainly, JAAA has sort of lit that space on fire, Cinthia. And I wonder, first of all, what you make of the rush into fixed income so far in 2026, and how much sort of the momentum behind CLOs in particular might continue as we kind of question what's going to happen next with the Fed's rate trajectory. Of course, with these floating rate securities, they've benefited from higher rates, and eventually the idea is what has gone up will come down at some point.
Yeah, I mean, fixed income, it's almost like we're living a market where there's two sides of the trade. One is that continued pursuit of the high beta, high growth names, and also the safety play. I mean, we keep hearing all the time now this year, which is, bonds are working again. That's great. Let's all buy bonds. If you look at fixed income flows year to date, to your point, Katie, we've taken in twice as much in fixed income assets as the actual footprint of the asset class. So it's huge demand. A lot of that demand on the treasury space continues to be in the shorter to mid duration plays. There's not any appetite really for long duration yet. But in the other side, on the high yielding things, on the credit side, the CLOs have really stood out. And there's a lot of firms doing a lot of interesting work there. So Janus Henderson had the original, AAA, JAAA ETF. Reckoner does nothing but CLOs. For example, their ETFs are doing amazing. And now you can play CLOs by tranches. A AAA tranche today is yielding about 5%, a BBB about 7%. So it's really compelling yields, very low credit risk to begin with, especially in the higher tranches. And nobody could access it before an ETF. I mean, CLOs were, institutional players, $1 million minimums, and now the ETFs made it anybody's game. And I think that's what we're seeing again, that access story, delivering access to something that nobody could touch before, and it's really compelling in this market.
Got it. Cinthia, I think we have to leave it there, but there's a lot, obviously, to dig into, and we'll definitely have you back on ETF IQ. Cinthia Murphy of TMX Vettafi joining us. Now, still ahead, we focus on a cannabis ETF through our Bloomberg Intelligence traffic light system, red, yellow, or green. That's coming up next. This is ETF IQ. it's time to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk level. So green light means low risk, yellow light means moderate risk, and red light means high risk. Eric, what do you have for us today?
Today we're looking at MSOS, which is the Advisor Shares Pure Cannabis ETF.
Wait, why is it MSOS?
Good question. Because it holds multi-state operators.
Oh.
These are companies in the U.S. that would basically distribute marijuana. Because it's federally illegal, Advisor Shares made a heads-up play. Most marijuana ETFs up to that point only hold Canadian companies. But a lot of the growth was in the U.S., especially recreation and medical. So this one used swaps to sort of get around the rule. Sometimes it's better to ask for forgiveness than permission in the ETF world. It's been tried many times. But this worked. Now, this ETF has $1 billion. Why are we talking about it now? It was our ETF of the month. Andre Yap brought it up on my team because the Justice Department is trying to move it from a Schedule 1 to a Schedule 3. This is important for just general usage, relaxation, and taxation. I didn't even mean that pun, by the way. But it's a better tax situation. So generally when regulatory changes might happen, these things jump. It's up 44% in a month. It's down a lot since lifetime, but has these nice jumps. The reason it gets yellow is because it's actively managed, so it's not an index fund. And number two, it's derivative complexity.
Swaps.
These swaps cost money. They are not normal, and we just want to make sure people are aware of that.
Yeah, it kind of reminds me of the conversation around small caps, and that, you think about the nice jump that it's had recently, and it doesn't necessarily look like investors are responding to it. And, you think about marijuana when it comes to sort of the reclassification, the descheduling. I mean, we've been here before. There's been a lot of head fakes. Yeah,
I mean, even with the 44% jump in the past month, it's still down 88% since launching. So a lot of these things are boy who cried wolf. Let me see a little more. This is Europe's problem for many years. Europe would have these couple months and then it's gone again. Small caps has the same issue. I think all these things that we're talking about, they need to outperform for years before they really get the people to move over. Because at this point, I think people are like, I'm not falling for that.
Right. It doesn't seem like something Raymond James.
Raymond James is definitely not involved with this stuff.
Yeah.
This
Although in terms of assets, it's got over $1 billion compared to, let's just say, MJ, which has a better ticker and only has 133 million.
Yeah, I think this is one of those retail plays. I think it's a classic theme. People may want to hedge their own usage.
Right.
That too.
That's one way to do it.
It's a hedging instrument. Eric, thank you. And of course, you can look at the traffic light system on your terminal at BI ETF Go. And coming up on the show, we speak to Nicolas Laqua. He is the CEO of Corgi on the company's record ETF launches. That conversation up next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get to the ETF life cycle where we focus on the various stages of funds. And this week we're focused just on the launch because this is a big one. Corgi Funds is a relative newcomer to the ETF world, but it's wasting no time. The San Francisco-based AI insurance company breaking an industry record with 34 new ETFs in one launch. The new offerings are a mix of thematic ETFs and other things. Prior to this month's rollout, the company launched the passive Corgi founder-led ETF, ticker FDRS. Now, let's focus on these launches with Nicolas Laqua. He is CEO of Corgi.
Yeah, and I mean, I guess we just have to start with Nico. The why. 34 funds in one launch. Certainly that turned a lot of heads in the industry from newcomers and old guards alike. So just talk us through your strategy. Why ETFs and why, so many right out the gate?
Yeah, we really wanted to make a statement, and I think that's what we did, that we're not just another ETF issuer. Our primary business is insurance. We're an AI financial infrastructure, AI insurance company. And insurance companies going into asset management is nothing new. We see that with companies like Prudential. We see ETFs as a space where investors need a lot more choices and a lot more options, and a lot better options. And we intend to repeat the same thing that we're doing to insurance to ETFs.
Looking at the lineup, what I found interesting, it wasn't just the 300 filings, that was also, you have a lot going on. The launches so far, you've got buffers, which are this own thing. It's really to make older people less anxiety about the market. Yours are lower cost. Then the total polar opposite is like high charge themes. I get the themes. A lot of indie issuers do that. But buffers are interesting to me. What made you want to get into the buffer world that's dominated by these big firms like Goldman and BlackRock and such?
Yeah, buffers are really interesting to us because we manage a lot of our own reserves, and there's something that we came across. What's out there right now tends to have very high fees, like 80, 85 basis points. We came out with like 30 basis points. And I think that like high fees for something that doesn't warrant high fees is something that just kind of frustrates us. So that was us kind of taking a stab at that.
Okay, here's the thing. I mean, this is such an interesting story. You guys are based in San Francisco. You're an AI insurance company. You're a startup. You also have a Corgi cafe in San Francisco. It's 24 hours a day. It's open. I actually stumbled upon it accidentally when I was in San Francisco last month, and there's a picture of me taking posing in front of it because I thought it was really cute. How and why did you get into ETFs? Because it seems like not necessarily a natural progression to go from AI insurance startup to ETFs.
There we are.
And there we are. There's your cafe.
Delicious.
Your offices are upstairs, right?
Yeah, our office is on the 5th floor. I mean, we went into insurance, and insurance is our primary business. And the reason we're there is because traditional and legacy insurance providers, especially as you go to like the most regulated layer of the stack, are really slow. They're bad. They're incompetent. They don't give the uninsured the experience that they deserve. And when we look at ETFs, we don't see the level of aggressiveness or of service that we expect with regards to new issuers. We view it as an area where it naturally aligns with insurance because we have quite a lot of reserves, and reserve management, asset management is something kind of innate to our business. We see it as something that our competitors, companies like Prudential, invest some amount of time and resources into it as issuers as well. And we think we can frankly do it a lot better than what's being done right now.
Well, let's talk about the steps you plan to take post-launch, because something we talk about this show on this show all the time is the fact that, it's relatively much easier to launch an ETF now than it was a couple of years ago, but certainly it's a lot harder to sell them. This is a very saturated, a very competitive market. So what are your thoughts around distribution? What does that look like for Corgi?
Yes, it's different for every fund that's being launched. I mean, some thematics are very timely, like EUV, for example, is our extreme lithography ETF, which is like an AI supply chain kind of play. So that's like a timely thematic. The buffers obviously target more institutional buyers. I think it's kind of a mixed bag, and as long as we launch good products, I think we'll be okay.
All right, let's look at some of these. One that stuck out was the U.S. war machine.
Oh, gosh.
It's a little cynical, but then you've got lithography. You've got the Bay Area ETF, which holds Bay Area stocks. New York City-based ETFs, which Athanasios wants to buy to hedge his increasing rent, he told me. Humanoids, quantum, and even urban air and coffee and energy drinks. This is a really big spectrum. Who's coming up with these? What's that like?
Yeah, I mean, if we think something's cool and if we think that there's value in being able to trade something, then we do it. And that's that. I think that giving more options to investors is a good thing. And as a company, we're investors because we have tons of reserves. Something that we must do, mostly fixed income, but equities are also part of the story for sure. And individually, the market is something that we care about. So if we come up with something, we just do it.
And clearly, you're doing it to also make sure that people remember you. I was just looking at some of those tickers. You had NYNY for the New York-based ETF. They're very clever, and it's a way that you kind of get stuck in people's brains, right? Like BZZ for drones and urban air mobility. Your mascot is a Corgi dog. So this is about appealing to the retail investor as opposed to the institutional investor, isn't it?
I mean, retail investors as well as institutional investors are just investors. And if we launch the best products, I think that both of them will appreciate the work that we do.
Let's talk a little bit about, where you're getting your money from, because, you're a newcomer here when it comes to the ETF space. You have the insurance business, but who is funding you? What does that look like?
Well, we've raised a bit over $260 million, most recently at a $1.3 billion valuation. As a company, the ETFs are still not material to our revenue, but that could change. And our insurance business is doing very well, and we expect it to continue doing very well.
So Ben Johnson from Morningstar, he calls it the spaghetti cannon. It's not just you, the whole industry, right? 1,200, it's 4 a day, by the way.
Yeah.
34 at one time, I believe, is the record, especially, at least for just themes alone. What's the plan here? How long will you let these last before you close up? Because we are seeing an increasing shortening of how long people will let these last. And do you plan to fire up the cannon again soon?
I think we'll launch a lot more very soon. I don't think we'll be closing. We don't have plans to close any of them right now because I think we launch good products, and I think good products will eventually see uptick. We'll see going forward, but certainly that's not on our plans, and we've closed 0 to date, and I don't think we're going to be closing anytime soon. I think that investors deserve choices, and there's a lot of ways that you can combine different product offerings to add value. And we'll continue doing that, and I think we should launch a lot more. Setting the record in one day is good, but I think we should beat our own record every single day.
So it's interesting you live in San Francisco. These two will tell you, I frequently call ETFs the Silicon Valley of the investing world. You're pretty much in Silicon Valley. How did you first hear of the ETF? Like, is this something people in San Francisco know about? Because you do seem in the tech front, which I'm not, sometimes I wonder, those two worlds actually meet. Obviously through you they do, but how'd that come up?
Yeah, I mean, I think that a lot of people in San Francisco and places like that, we're very busy, and I think that investing quickly in a basket of offerings without researching every single name is something that's valuable. I grew up investing in ETFs. I think when our team mentions the stock market, we speak in ETFs. I think it's just something that we're comfortable with, and where we haven't seen that much innovation relative to taking rocks out of the ground and making them talk and think. I think we can shake it up a little bit.
All right, the new generation of ETF issuers.
Rock and roll.
Nicolas Laqua, thank you so much, of Corgi Funds. Really appreciate your coming into New York today.
Yeah, thanks for having me.
Coming up on ETF IQ, we're going to speak with Ally Wallace from Morgan Stanley on their recently launched Bitcoin ETF and what they're doing with digital coins overall. This is ETF IQ on Bloomberg.
We're just about halfway through the trading day in New York. I'm Norah Mulinda. Let's take a look at your midday movers. First up, the S&P 500 is sitting near a session high as investors weigh strong earnings reports against news the U.S. and Iran failed to reach an agreement to end the war. Energy markets are reacting to those fading deal hopes. President Trump says the ceasefire is fragile, calling it, quote, on life support. Crude prices are climbing, with Brent topping $104 a barrel. WTI holding above $98. In corporate news, Intel, Micron, and Qualcomm are among the chip stocks powering the market higher today. The rally is being fueled by ongoing enthusiasm around AI infrastructure spending, with all three names hitting fresh record highs. And finally, Tyson Foods is on pace for its worst day in over a year. That follows a Wall Street Journal report that the U.S. could temporarily lower beef import tariffs as soon as today. Those are your midday movers. I'm Norah Mulinda.
This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we have the Morgan Stanley Bitcoin ETF. Pretty vanilla. It holds Bitcoin. The custodians are Coinbase and Bank of New York. The biggie here is that it's Morgan Stanley, first bank to issue a spot Bitcoin ETF, and the fee is 14 basis points. That is the cheapest on the market. This made a lot of waves. And if we want to show the next screen, I'm going to show you the flows into this have been very good. Now, Bitcoin obviously has been struggling for 6 months, although the last month has been good. And the flows have been pretty consistent. Morgan Stanley has 16,000 advisors, so that probably helps. And so this was, I would say, the most important launch or notable launch since IBIT, in my opinion. Let's look at the performance versus IBIT. Now, this is interesting. IBIT obviously is the big liquid one, but this one's beating it by 3 basis points. Again, only over a month. If you annualize that, it gets to kind of some interesting gap there, Katie. 14 to 25 bips long term can add up. Short term doesn't make a big difference, but this is going to be an interesting new entrant and even a challenge to IBIT.
Absolutely. Eric, thank you. Joining us now, I'm pleased to say, is Ally Wallace. She is Global Head of ETF Strategy over at Morgan Stanley Investment Management. Great to have you with us. I want to just start with the why. You launched this pretty much a month ago, and you think about the first wave of Bitcoin, spot Bitcoin ETFs, they came out in January of 2024. So you were a bit late to the game, but of course you undercut on fees in a big way. So just walk us through what the conversation sounded like coming up to this launch.
Right. So, I mean, it really did come about from client demand. So, there, as you know, from a Morgan Stanley perspective, there has been several different announcements across our wealth and institutional trading in the last month or so. So, it really is a firm-wide effort. But clients were asking, and I think there is still a big need for education around how this fits in your portfolio. And so, last year, our wealth actually gave specific guidance toward that. It's a 0 to 4% allocation. And this product really fit into meeting a lot of that client need. And it hits all the three client segments that we really look to touch when we're launching an ETF. So really going after the direct investor, and that's where a lot of the initial flows has been through our E-Trade platform, and then as well as the intermediary. And then eventually, I think we'll get more into the institutional. So those are some of the initial conversations we're having.
So this is to address client demand. What is the demand for a Bitcoin ETF versus just exposure, pure exposure to Bitcoin specifically?
Yes. So, I mean, as you can see, that we're having conversations across the gamut right now, some being very new to the space, trying to understand, do I want to have this allocation in my portfolio? What are the benefits, opportunistic value? And then there's those that have been native holders for many years and actually want to almost offset some of that exposure of holding it off, on chain and having it more in the more traditional finance structure, being able to use it for margin, more traditional wealth planning. So it really has been such an interesting conversation because each investor has really been very different.
So let's talk about Morgan Stanley as a wirehouse.
Right.
One of four big ones, but you're the biggest. If you look, you've got $7 trillion in wirehouse advisory assets, and as I said, 16,000 advisors. That's why this is a big deal. And those advisors, 0 to 4%. Now you're the cheapest. There's no reason not to use Morgan Stanley. But where are we in that penetration into that advisory market? Are we at like the first 1% or first inning? I mean, do you see this kind of dominoing into all of them or just a portion? How big could this get?
Yes, I do think that we're very in the beginning innings of it. That is why we felt worthwhile to actually launch the product. I mean, if you look at even, the longevity of ETFs, if you would have stopped 2 years in, you would not have had, the uptick of the 20 years. So we really feel like it's very early innings, and wealth does as well. So that's why you're seeing a whole infrastructure rebuild across the firm in order to incorporate it in different parts of the firm. So whether that be wealth and in our trading aspect, this is a product that we also plan to bring several different iterations of innovation on top of. So we have an Ethereum and Solana product coming soon, and then we'll use these as building blocks in other products.
It's interesting, Morgan Stanley's ETFs, it kind of tiptoed around, but you went full Terradome with this one at 14 basis points. And then the E-Trade announcement, your E-Trade is going to let direct crypto trade for 50 bips. Yes. Schwab had just announced 75. I'm sensing a fee war in the making. What do you think, how is this going to play out? Are we all going to be able to buy Bitcoin for almost no fee in a year or two? What's going to happen here in terms of this fee competition?
Yeah, I mean, I think you even have seen that with ETFs. Like if we did a ton of obviously history and back looking to when these launched in 2024 and the fees that were associated with custodian, lines of credit, everything that was in that ETF ecosystem has been compressed, even in the 2 years that it's been out. And so we are, obviously took advantage of that. And then E-Trade and the trading aspect that's going live there, feel the same way. So obviously as Morgan Stanley, we do have scale, are able to actually bring, pricing power to that. I don't know if we're going to go to zero, but I do think that you'll get a lot of fee compression in the next couple of years.
So I don't know if everybody knows this, but you used to work at BlackRock. You helped birth IBIT along with Ravi Mitchnick, who we've had on the show a couple times. BlackRock is like the Terradome warrior, like they're the ultimate warrior. How did that help you inside Morgan Stanley? Because we've seen these older legacy firms, it takes a minute. How has that gone? Are the bigs at Morgan Stanley more open to like getting into ETFs and making them cheap and crypto? How's that happening?
Yeah, I mean, it's been an evolution, as you can see at most asset managers that are taking on ETF business. There's a ton of education that happens in the first couple years, and then I think it's been, obviously the market has helped us out in a lot of assets going there, and so the conversation has really sped up in the past couple years of how do we grow this platform, how do we get aggressive with it, and having the BlackRock DNA is always helpful just because it is quite aggressive and they're there to play. And so trying to bring that same mindset to Morgan Stanley as well.
You say BlackRock, I think model portfolios. Is that something Morgan Stanley is doing as well? And if so, how does now your Bitcoin products fit into that model portfolio?
So we are looking at the model portfolio. It is very early in that, I'd say, journey for us. But it is, I think, as anything, it will be a long-term allocation that we are looking to actually have from the model portfolio as well.
All right, so we'll continue to watch that space. Ally, great to get some time with you. Appreciate you stopping by the studio. That is Ally Wallace of Morgan Stanley Investment Management. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter.
All right, coming up on ETF IQ, the television program, it's time for an IQ test where Joel Weber puts our ETF knowledge to the test. All three of us are back together, so we'll see who's going to come out on top. Here's a sneak peek at one of the questions. Which thematic ETF, what was the question? Can we go back?
Has had the best returns?
Has had the best returns. Okay, strongest returns so far this year. Thank you, Katie. 5G, defense, nuclear, or space?
Google it now.
We're not allowed to.
Yeah.
This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Katie Greif along with Scarlett Fu and Eric Balchunas. And now it's time for the IQ test where Bloomberg's Joel Weber, he's the head of games. He's going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. He co-hosts the Trillions podcast with Eric. And as I mentioned, he's the head of games at Bloomberg.
We love the title, right?
We're going to have some fun now.
Yeah, all right.
I'm ready to administer fun now that the band's back together.
Let's make it hurt.
Okay, we'll find out how much. Okay, question number one, posed pre-tease. Which thematic ETF category has posted the strongest returns so far this year? Is it 5G, defense, nuclear, or space?
But why is memory chips not on here?
Well, it could be
too easy.
Kind of maybe none of them, or maybe all of them a little bit.
Okay.
Yeah.
I'm going to say space, D.
I'm going to say space too, just because, we have SpaceX coming down the pipeline. I think maybe that's creating
There's
a halo.
some enthusiasm.
Yeah.
SpaceX feels like a red herring. I'm going to go 5G.
Okay.
Well, then it's 5G.
Oh, we got him. He did too much mental math on that one. It is D.
All right.
Sometimes the most obvious answer
I
is the right
midwitted
answer.
it.
Yeah.
I should have just gone with the obvious.
Got to be at
Eric,
the end of the bill.
down to the ladies. Question number 2 we have for you. Which stock in the S&P 500 is most owned by actively managed ETFs at about 45% of its shares? Is it A, Ingersoll Rand, B, Caterpillar, C, NVIDIA, or D, Applied Materials?
It's not C.
Okay, she's ruling one out.
I'm going to say Caterpillar, B.
Katie?
I'm going to say A, just because I imagine that's a small ETF.
Okay.
Or it's a small stock.
Okay, Eric, have you
that's
been
a good question.
reading closely?
It's going to be, I'll go D just to be different. It's got to be something unusual.
Eric's down 0-2 now.
Oh my God.
Got a little streak.
Nice.
Oh my God. Wow, I used my logic. Good.
All right, final question. This is a painful week.
It
How does
is.
it feel, Eric?
It's embarrassing.
About what percentage of ETFs have been on the market for 3 years or less?
Oh, I'm
Is it
money
A,
here.
15%,
Oh, hell
B,
yeah.
25%, C, 46%, or D, 65%?
I'm going to go with D.
It's B.
It's C.
Oh, wait, I read it wrong, but I'll stick with B.
It is C. He redeemed himself at the end. So, all right, that was a heated little round.
Yeah, that's Athanasius.
I was thinking about flows.
You still emerged the victor of this round.
It feels good.
Congratulations.
I'm gonna take this.
And if you like playing more of these, go to QuizGo on the terminal or Bloomberg.com/pointed, where you can play our weekly news trivia game.
Absolutely. Joel Weber, thank you so much. Of course, that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas. and this is Bloomberg.